Everybody, if you have been following my videos for a bit, which probably about three of you have, you know I love Dollar General stock. I think it is fantastic. I think it will perform excellently, especially in 2025. But we got to talk about it once again. So I'm going to do the full analysis and everything of Dollar General once again, but mostly focusing on the chart and where I think the stock will be going in the short to medium term. So we're going to get into that. That'll probably be most of the video. But anyway, I do these kind of videos, stock analysis, stock reviews, stock market content in general, every single day of the week. If you're new, make sure to subscribe. I'm a genius, really. Not actually, but I try my best. And yeah, that's about it. So let's get into Dollar General. All right, so I think everybody knows what Dollar General is. If you're my subscriber, you better know what Dollar General is because I love them. But let's just go over some quick things. First of all, same store sales growth projected to grow across the year. 2025 estimate is 1.3% each, which honestly, not the highest number that I would like to see, to be honest, but pretty solid, if I had to say. Net sales per square foot. This is quarterly. Actually expected to decline year over year, which isn't fantastic. Selling space per square foot. I don't even know what this metric means, but that's going to increase. So yeah. Number of stores is expected to increase very significantly. They're expected to add about 700 new stores, which is good. And then just stores closed and stores opened. You could see not too many. I don't know how they estimate stores that are already being closed in 2025, but I mean that's something they do. So overall, 16 billion market cap, which is, in my opinion, very low for this company. Very low. 3.2% dividend, which is good, but also I honestly believe this could start hurting them uh, in the next couple of years just because their profitability is decreasing. And I think this fairly large dividend could kind of come back and bite them a little bit. Target price is at 88. Right now, we're sitting at 74. My own personal target price is right around 150 to 200, at least for the next 5 years or so. That's just what I believe. If we go into I think I missed it. Here it is. The growth summary, we can see across the board, long term growth is expected to be very solid. 8% 10-year sales growth is really good. Net income is projected to grow. So it's mostly the short term pain that they are going to be feeling. And I do have some explanations for this. So, one, they had a very large sort of headwind from COVID. So COVID boosted their sales greatly, as you could see, going from 25 billion to 33 billion very quickly. And now they're all the way estimated to be at 40 billion for 2024. So one thing to note with all of this, um, their sales are not slowing down. They are still increasing sales. It is profitability that is the real problem. Most of that comes from cost of goods sold, which you can see is increasing right alongside their sales growth. SG&A expense also is a fairly decent amount. Their EBIT, or their operating income, has been decreasing despite their very large sales growth. So 3.5 billion in 2021 with 33 million in sales. That is very good margins, especially for a retail store, to now 40 billion with 2 billion in operating income. That is not great. And actually their net income, if they continue at this rate, their net income is going to be negative within a couple years, possibly 2 or 3 years. So does not look great for them. You could see 2.6 billion profit 2021 compared to 1.3 now, despite 7 billion more in sales. So they have a lot of work to do with their margins. And that is something that I, as an investor, fully understand. So one thing I do like, total shares are declining, and they are declining significantly. 2019, they had 259 million shares. Now they're at 219. That is fantastic, in my own opinion. Total shares is a very important thing for me. It might not be as important for you, but for me, it definitely is in terms of long-term value for a company. So going into their income statement, I'm just going to look at the past 5 years, but we could see they have an okay amount of cash at 500 million. Um, Honestly, not the greatest, but compared to where their short-term debt is, but it's should be okay for them for the time being. Total assets are steadily increasing. They have 33 billion now, up from about 13 billion just 5 years ago. So a tripling, almost tripling their assets in 5 years, which should, in theory, start paying off more and more into the future. We can only hope, but that is how it should go. Short-term debt at 2 billion, you can see that steadily increasing over the years. Long-term debt is supposed to come down in 2024, which hopefully that does happen. I think their long-term debt is one of the biggest problems of the company, other than obviously profitability, but their long-term debt definitely needs to be worked on. Other than that, obviously they have positive retained earnings. They have for a while, but again, the retained earnings is in trouble. I mean, they could start seeing that go negative depending on what happens with their profitability. So overall, going into the cash flows, everything looks pretty good, other than that net and operating income where we saw declines. Everything else looks really solid. Even their debt really isn't that high compared to where they are as a company. And also, as we saw earlier, they have, you know what? I'm going to go back to the balance sheet because I got to talk about this now. They have 33 billion in assets. And what did we say the company was worth earlier? 16 billion. They are at half the valuation of just their assets. That does not happen very often, at least from what I understand, based on the dozens of companies I reviewed. Your market cap should generally be mostly in par with your assets, maybe a little bit less, maybe a lot more. It just depends. But having half of the market cap that your assets are is unprecedented, to use a big word. So going into the cash flows, we could see fairly good operating capital. They're actually seeing a very high 2024, the estimate at least. So looks very good for operating. Changes in working capital is actually increasing, which isn't terrible, but the most of the increase should come from funds from operations, which obviously that is part of changes in working capital. So that's not a negative thing. Other than that, CapEx is the investing activities. We could see they have been slightly selling off assets, although that is very minor, nothing to really comment on there. And then for their financing activities, it is mostly the consistent dividends. We have seen, of course, some debt reduction, which is fantastic. That is exactly what we want to see from the company. They need to reduce the debt and then use that extra leverage to invest in increasing profitability. That is what I want to see done. That is what hopefully the company is gearing up to do. So, moving out of there, one thing I do want to show is their sales growth. Their sales growth has been excellent. This is the past 10 years, and you can see only up. Now, it does look like it is slowing a little bit here, but again, if you look, that is 2%, 3% sales growth. So 2% sales growth in 2024, not fantastic, but it's not something we haven't seen before. In 2022, they were at 1.4%. They're expected to continue increasing sales long term. Although, again, just based on that kind of very large run up that we saw from COVID with their sales, I think it's going to take some time for them to catch up to where they want to be in terms of just profitability and increasing sales overall. So, speaking of profitability, let's take a look at the ratios. So, obviously, this is the big thing with their company. Their ratios are declining, and we can see that here. Gross margin is at 30, below the 5-year average. Operating margin at 6.3 from an average of 8.7, and then net margin at 4.3 compared to 6.3 average. So, overall, not great there. Return on equity is still fairly high, although it is obviously down over the past year. Return on assets, kind of the same thing, well below the average. Overall, not great for their profitability. This is the big thing that the reason I keep bringing it up is because this is the most important thing that they should be focusing on. They need to improve their margins. And in their next earnings report, which we'll get into soon, that is the big thing that I want to see improved. So now let's get into their earnings and see if we can find anything good. So metrics recap here. Hopefully they have ratios, which yes, they do. And we could see operating metrics 1.3% compared to the estimate of 1%. Gross margin at 28.8, but above the estimate of 28.4, although a slight decline from a year ago. SG&A is slightly increased over the year and the estimate. Operating margin was below the estimate and over 1% below a year ago, which again, not great. Merchandise inventories fell, although sales increased, although inventory per store also increased. So that is one thing that I will say is positive. They are clearly being more efficient with their sales based on their inventories falling, but their sales increasing. So overall, that is positive. Now, they need to continue this in the future. I'm not saying massively decrease your inventories because as a retail store, you do need to have inventory um, at all times, but they need to work on increasing their efficiency, increasing their margins, which we could see a little bit. I don't know if this is them hopefully implementing new strategies where they did slightly beat on where their gross margin was, but their operating margin just couldn't really come in as well. But overall, not too bad for that report. So this is just some analyst comments. As we could see, one thing I want to point out, targets lowered across the board, which is not great. That is not what we want to see as investors, but every single one, other than it looks like this one, which didn't directly say anything, all of them lower their targets, $81, 83, 88. So overall, not fantastic. They do have an average of a hold rating, which again, there obviously is some problems with the company. Um, some comments that I'm seeing here: progress with initiatives, um, focus on existing stores rather than just store growth. I think that is very positive. I think they should do that. I mean, if you, at least where I live, you could see Dollar Generals are everywhere. I think instead of growing their stores, they need to focus on having the stores they currently have make more money. You could see Walmart is stated here as taking a lot of their traffic. That is most likely true. One thing they can do is do the quantity over quality tactic, where if there are Dollar Generals everywhere, which again, we don't really want to see that. We don't want to see the stores everywhere. We want to see their current stores being more profitable. But their strategy is have a Dollar General in between every Walmart. Therefore, when people can't go to Walmart or they don't want to drive to one, they have a Dollar General nearby that they can go to. So that is their strategy. And I do believe it is a good strategy that will work because obviously there's a ton more investment in um, creating a new Walmart location, and there needs to be a much higher customer base. While when you have a Dollar General, you don't need as many customers in order for it to be successful because they're smaller, they're more focused on specific items. So I think their strategy is good. It just needs some refining and tweaking in terms of their efficiency. So overall, not terrible here. Obviously, price targets lowered is not something we want to see, but anyway, let's get into the chart. So Dollar General has a very long-term support line that we could see here that they have been following. Unfortunately, it's a declining support line, but if we also draw the wedge here, we can hopefully see where they will start converging, and hopefully we can see a sort of point in the future where they will hopefully pop out of this downtrend. Now, I'm not saying it will happen at this exact point. It could be their next earnings report. It could not be, but they need to break out of this downtrend. I do believe that while it's on the support line, it is a fantastic buying opportunity, at least for myself. Um, I honestly expect the company to be able to recover from this declining, at the very least, getting back up to the 100 range. That is my short term price target. I think this gap should be filled at some point. Obviously, they had that terrible earnings report where they lowered guidance across the board, especially for 2025. But I think if they could surpass their estimates in 2025, we will see them start to make a comeback. But overall, this is where we are. You can actually expand this a little bit further, but it doesn't fit as well. But overall, this is what we're looking at for Dollar General with their chart. They need to see an upwards break here. If not, we could see the stock price going all the way down to probably right around the 60s range, which I genuinely believe there is so much value here that it can't go that low. If they drop to even $50 and their market cap is I think like 10 or 12 billion, that is a ratio of their assets being at over 30 billion compared to their market cap of 12. That ratio doesn't make sense. So overall, I think just based on where their assets and equity alone are, their market cap should be significantly higher than it is now. And I believe we will see that in the near future just based on how far they've fallen. But overall, I have ranted way too long about Dollar General. That's all I have. Make sure to subscribe if you haven't. Hope you enjoyed. Subscribe. See everybody next time.